All right. Good morning, everybody. December 1, new month. Already hearing about how fantastic and awesome November was. Yeah, whatever. It was a good month, though. TGIF, right? Yeah. Take it while we can get it. Had some new people today, so I'll just kind of give a little update that new people haven't heard before. Yeah, I'm going to give you a fish today. We're going to go through a bunch of stuff that's going to prepare you for the trading day, but that's not really my goal. I'm trying to teach you how to do this for yourself so that you don't need to get up really early and listen to somebody else's morning briefing. You'll be able to do your own, and it'll help you look at the things that you want to look at instead of the things that I want to look at, right? So that's kind of the idea. I don't take questions during this Zoom session, but you can always ask questions. And if it fits into what I'm going to talk about anyways, then I'll hit it. If not, just ask me after the Zoom and we'll go through it afterwards. Kind of a mixed bag around the world. Hong Kong down more than 1.25. US markets are flat, basically. We did get a fantastic move in the kill zone. Take a look at that. And Europe's up about 0.5%. It's going to be one of those days. We got Powell talking today. We still have a lot of other Fed speakers that have been out this week whose data is still being digested. And we got ISM manufacturing. So a pretty full day. Remember, we use Market Watch because they tend to highlight just the biggest economic events. They don't mess around with trying to give you everything, just the big ones. FX Street has this impact rating, and they try to list a lot more stuff. So if you're newer to gauging different economic events, trying to figure out which ones are more likely to move the market than others, this is a good place to go. Now, it's not perfect, right? Because sometimes we get data that normally wouldn't move a market that suddenly does, or data that has moved markets before, and then we get data today and it doesn't. It's just a dud and we don't get anything. So it's not perfect, but the idea here is looking back statistically, historically, what tends to happen to the market when we get, say, ISM numbers? It has an impact to the market. To me, that gets translated into volatility. Volatility is a nerd word for movement. High volatility, big move. When we just get rid of the fancy talk and put it back into plain English. Wrap it up with finance juice, stopping by here just to get this little excerpt. So this place is great. They always have a current list of people that are going to be speaking today. They try to do really good on capturing all of the different minor and major economic events for the day, but then they also do these market wraps. Europe isn't closed yet, but they know that we're coming in, we're getting ready for our day, so they go ahead and give us a European wrap, which is great. They'll do a morning brief before the open for the US markets. After we close, they'll give an aftermarket summary, and they do it for the Asian open and the Asian close before Europe opens. So it's a really nice kind of a heads up snapshot of what's going on out there. We got Goolsby, Powell, and a couple of ECB speakers today, including earlier today, Christine Lagarde again. Well, she's got to be getting tired. Eight 8:30, 9:45, 10, 11, 1, and 2. That's a full house. At 1 o'clock, it's just the rig count. I worked on those rigs for most of my life. The numbers doesn't change very much. And Usually the biggest change to those numbers is when we get a new fleet online, or if they have a recall and they have to take a bunch of fleets offline real fast. That's usually the only time we see a sudden unknown number drop or number change. So while I would never say that you should ignore the data, and 1 o'clock fits in with what I always say anyways, watch the clock, not expecting the rig count to be all that much volatility. We're getting really close on the ES to the rally base drop zone here, that 46.50 kind of line in the sand. If you look at other markets, it's already made it back up to this level and through that level. But, you know, this was still dragging its feet. So you can see the just fantastic, absolutely amazing move for November. But, you know, that's done. It's gone. There's still an argument on whether or not we should remain bullish. And until we get into this zone with those sellers and see if those sellers are still there, then can't make an argument for a bearish case yet. Let's look at the spot gamma levels. I didn't hit that. All right, so just grab a screenshot. That way you're not trying to scribble these numbers down real fast. That's the S&P and the ES. You really just need the call wall, volatility trigger, zero gamma, and the put wall. Think of the call wall as, I don't really like to say it's resistance, but think of it as that. It's just where a big wall of sellers are at, and the put wall as support. And then for the volatility trigger or the zero gamma, whether or not we're above them or below them. Here's SPYs and a screenshot, right? Just grab it, draw it out on your chart later. And the Qs. This is one of those that has to be updated every day. So as you can see, we're above the volatility trigger. We're above zero gamma. We're still underneath the call wall. And as long as we're above those levels, we want to look for bullish opportunities. When we're below them, we want to look for bearish opportunities. Pinning strategies like butterflies and range strategies like iron condors, they tend to work better when we're above, just because the average daily range or the ADR tends to be more containing. When we're below those levels, we expand farther through volatility, right? And so we tend to break levels like weekly expected move and ADR levels. We attempted again to get an inside week breakout, and it failed again through the kill zone this morning. I mentioned it earlier. The kill zone is this time frame between 2 and 4. It's the 2-hour window in a 24-hour trading day that statistically has the biggest moves in a 2-hour period. Bigger than the open, bigger than power hour, bigger than anything. And of course, liquidity gap. If you move really far, really fast, you tend to mean revert back to where you started. And then, of course, you get a little bit of an overshoot. We see that with PPI at 830 or CPI at 830, one of those liquidity gap plays. This is just a minor version of it. Volume is within normal range. It's cumulative volume. That's all we're looking at to see if it's within normal range or not. If it wasn't, then we'd want to know why. We'd want to head back over to the news and try to figure out, why is it heavy or why is it light? It's not heavy or light, so we just get it out of the way. They are hedging this morning. We can see that they're hedging because there's a market maker move. If you're unfamiliar with that phrase, it's a think or swim concept. They made it up. It's right here, market maker move. If a market does not have a market maker move, you just won't see something there. That's something that I've asked them to change. They don't listen to me, so they don't care. But it's not something that you turn on or off. It either is showing there or it's not. And what a market maker move is, if the front IV gets greater than the next series out, the differential between these two is quantified. That is what a market maker move is measuring. We use it just to identify, hey, are they hedging? Because if they're hedging, they're going to hedge in the front end. They're going to bid up a bunch of contracts to protect their bum. And we're going to see that front end's IV rise higher than the next series out. Dun, da, da, da. We know they're hedging. They are hedging this morning. That also gives us more movement. So the ADR half levels are the two red lines here. I know there's a lot of red lines. 45.92.5 and 45.50. So that's the ADR half. If we take the ADR in a single direction, then we get the yellow line here, 46.13, or we get the yellow line down here, 45.30. What we do with this market maker move is we add that to the day's range. If the ADR, average daily range, is 0.91, and we add 0.39 to that, then we now have our average daily range and the additional volatility measured out onto our chart for the day. It's another $18 beyond where we're already at. I like to just round things to make it nice and easy. That puts us at 45.15. And oh, gee, golly, look at that. That takes us all the way down to 0 gamma. It's also an inside week breakout. We would be breaking outside of last week's low. To the upside, from 46.13, add another, quote, $15 to that one way or the other. That'd get us to about 46.30, which would be right up there at that distal line. And that's where we would expect to take a rejection anyways. You can see that we've been holding sideways long enough that the 10-day moving average has caught up with us. We almost tagged it yesterday. So if we break 45.50, which is a very significant key level anyways, if we break that, we're going to interact with that 10-day moving average today. We're still a long ways away from the 10-week moving average. So I don't think we're going to get into contact with that today. 10-day, 30-minute volume profile with TPO. TPO is in blue, volume profile is in green. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We got the point of control at 45.64. And really, there's no shallow area until we can break through that 45.20 that we've been talking about through most of the week. 45.50. We're not even close to the 45.20 area that we had spoke about. Notice how narrow the range is. We're back to a 95, 100 point range. This is tight compared to what we had been seeing. Through the day today, we're going to lose more of this candle down in the lower left. And by the end of the day, come in Monday, we're going to have this at 45.20 plus whatever we're going to get up here. So it's going to just keep restricting us. By the end of Monday, this zone, there's no way that this zone is going to be our zone, right? Kind of think that through. This would be, by the end of Monday, how tight we would be. Whew, it's been a while since we've had a 50-point 10-day range like that. So I mentioned earlier in the week how I have been buying 1 day out of the money options in the SPY at about 2 or 3 pennies. And these are just scratch lottery tickets, right? They're not strategy. They're not based on, support, resistance, momentum. They're just, look at this really tight range that we have. That can't hold. The phrase that I like to use is can't stay here, right? There's certain times where we just get into a nice little tight dynamic zone. Can't stay here. We're going to leave. Well, we know we're going to leave. There's no way we're going to hold this range. When it comes, it's going to be a gigantic, violent move. And there's no reason to spend money on that day after day, big money, just throwing it out the window. But a $3 put, a $3 call, that's $6 a day. And if it doesn't work, so what? You lose your $6. When it hits, you're going to make it all back plus some. So I continue to do that. I've closed a few of them out at scratch, meaning I opened it for $3 and closed it for 3, or maybe opened it for 3 and closed it at 5. But most of them have just gone to 0. And I've been doing that all week. We haven't gone anywhere all week, so they haven't paid out, but I'm going to continue to do that. You could just put on a longer dated straddle or strangle if that's your jam. I don't want to tie up any buying power with this. And they're just lottery tickets, right? Like YOLO. So, the VPOC that we had marked out was hit even before the open yesterday. And really, it didn't get that much respect anyways, but we saw price really respond to that level from Wednesday's price action, right? That point of control from Wednesday, we carried it forward. We can see how we really built up a lot of volume on Thursday at that same area. It wasn't the point of control, but we didn't spend the same amount of time there anyways. There's still a significant level of volume in the high of the day. And if you were looking at footprint chart or a TPO chart, it was a significant level of volume yesterday afternoon as well. How much of that attributed, to this price shelf back here is easily seen with the footprint chart. I actually had a call that was worthless, and I mean worthless. It went to 0 on this pullback here. And so I didn't close it because, I mean, it's out of the money. It's at 0. Why even bother closing it? Well, that spike into the close after fees and commissions, that was a $900 spike on a 55-cent option that had gone to 0. 10-minute move into the day saved it. So we had a really narrow IB last night. IB is initial balance. It's the time between 6 and 7 at night. Now, I have heard some more modern traders use an IB that starts at the 9:30 open. To me, that's RTH open, or the, like the 5-minute open. There's a lot of open strategies, but to me, I use it the way it was originally developed. IB is initial balance that starts between 6 and 7. And it was a really tight zone and a really tight range through the overnight. The education behind that says if you have a tight Globex, that any work that we can presume needs to be done today, firms coming in and, modifying their position, hasn't happened. Because if they had come in and traded, price would have moved already. So a narrow IB implies unfinished business. There's still work to do, that we could make some pretty good moves on the day. If it was a really big, really wide range, then the opposite would be true. We would take that as business is finished. They have no reason now to come in and trade. They've already done their trading for the day. That does not take into account the kill zone, by the way, which is an entirely different part of the whole thing. So this is just a really tight zone through the overnight. We've reset from the move through the kill zone, and we're getting a little bit of overshot. That's not bearish, right? That's just Linreg. least squared methods, dot plot statistics, linear regression. It's just reversion with an overshoot for now. That can change, right? We can still bear up if we want to. So like we do every Friday, I want to take a look at next week's range. This is the weekly expected move. Take the week that we are currently in right now, just nice and casual, draw a box around it, set it on next week's range. Now, look, if you're some psycho engineer that wants it down to the penny, then do that. But I mean, I just want a quick visual. Is next week's range bigger or smaller than the range that we had this week? If I overlay that box, I can see next week's range is just a little bit smaller. These ranges are derived based on volatility. So the implication is that they're pulling volatility out of the market. Well, that makes sense. We rallied up really strong in November. Moves to the upside tend to take volatility down, and we're seeing that. But it's not by very much, right? They didn't really take very much volatility out at all. Now, this box isn't set in stone. It won't lock into place until 4:15 tonight, but this is a snapshot of what we've got to look forward to. Notice what we've done all week, how close we stayed to Friday's level, right? That's where we closed last Friday, and all week we've just hovered right there. That's the mean. That's the average. That's our key level. Think of it as the center of the basketball court. Now, what I'm curious about today, if you want to think about some lottos, is an out of the money option, not in the ES. I mean, you could, but why? In the SPX, which is what I was using yesterday for that $800 move in the last 10 minutes. An out of the money option on each one of these lines. So, you know, swap it over to the SPX. $46.10 and $45.05. A put and a call because, you know, coin toss. This takes technical analysis out the window. If you think we're going up, just buy the call. If you think we're going down, just buy the put. If you don't want to think about it at all, just buy them both. It's not like you're spending a lot of money, right? That far out of the money, it shouldn't be very much. And if it is, just turn it into a spread. Now, these numbers haven't updated yet, right? That never trust pre-market options data, at least not on Thinkorswim. So 50 cents, 60 cents, that's a bit more than I want to spend for a lottery ticket, right? These are supposed to be gas station scratch lotteries, couple of bucks, not $50 to $60. If I'm going to spend that kind of money, I'll put some analysis behind it and have a reason to believe we're going up or going down. If we turn it into a spread, we're looking at about 20 cents for the upside move to get to the weekly expected move edge. It seems odd that we should be able to go that far in a single day, right? Because that's the range for the entire week. And yet, if you've been around for a while, you know that we've been able to make that move in a single day more than once, especially after being so tightly constricted IX10 all week. We are building out a little bit of a megaphone pattern too. So there is that. SPY would certainly be cheaper, but SPY doesn't have the same rate of change within its options structure. I know it's a little early in the morning to talk nerd like that, but basically just saying that the options in SPY, the price of the option itself doesn't move as quickly as the options price in the SPX. But a 461 call on SPY, 0 day, 7 or 8 pennies. That's not bad. It kind of fits with that 3 or 4 penny discussion that I was talking about earlier. You wouldn't be wrong if you just go out here a little bit farther and do grab, a 3 penny option. So far, we have no reason to think that we're going to hit that edge. But with Powell and everything else that we have on the table today, we could, right? ISM manufacturing and Powell. Plus, we got job numbers from Canada. There's quite a bit of economic data today. There's enough that the hedging continues, right? They've already put more in here since we last looked at it. So they are continuing to hedge. And look at that move. Think somebody got a little bit of the numbers, right? So it's absolutely possible. Yeah, and look at that dollar go. So that'll be our backdrop right there. If the DXY continues to run to the upside like that, then we're going to have to continue to focus on the S&P and the NASDAQ dropping off. It helps that we have the 10-year above the VWAP and trying to continue pressing to the upside. Remember the Dixie by itself, we've seen multiple times this week, even in the last month, where the dollar was moving and the indexes didn't care at all, right? They just shrugged it off like, whatever. So seeing the dollar moving this morning like this and directly seeing the impact to the downside, I don't think it's just the dollar, right? In fact, if we line up my mouse right here on this drop in the NASDAQ, we can see it ties in with this V here on the 10-year, not necessarily for the dollar, because the dollar stalled, fell back down. We didn't see any of that stall here in the NASDAQ. We didn't see any of that stall here in the 10-year. So I'd say it's the 10-year whacking the S&P and the NASDAQ, and the Dixie's just helping out. Makes sense. It's not stocks versus bonds this morning either. It's stocks and bonds both headed to the downside. Generically speaking, stocks, index, and bonds, any of them. I'm just using the 30, but 10, 20, whatever. And take a look at US dollar Japan, nice tight zone. Been holding it all night long. That's a very beautiful pattern. If we can get a breakout on US dollar Japan to the upside, get through that 149, Dixie say above 104, 10-year above 4.37, we could have a really nice sell-off today. And look, I don't care, right? I don't care which way we go. Go up, go down. We can go sideways as long as there's something to trade. I'm down for a 100-point wide SPX trade today. Get a nice $42 SPX credit spread. That sounds good. Got to see it play, though. All right, semiconductors are down. China ADRs, nat gas, emerging markets, which fits in with the China ADRs. The benchmark is 0.5%. So we kind of stop right there. If it isn't down at least 0.5%, then it doesn't need to be on our radar, which means all of these in the middle don't qualify. And I'm pretty generous at 0.5%. I know a lot of analysts who use 1%. If a market in the pre-market hasn't moved more than 1%, they don't even bother looking at it. Speaking of 1%, Bitcoin is up more than 1% this morning. Which makes me want to consider the Bitcoin proxies. Cloud computing also is down. Nah. So that could spread out a little bit. If we've got semiconductors down, then it might be worth a look at a lot of those other semiconductors. Definitely not AMD. It's doing pretty good this morning. So it's just SMH by itself. TSM's looking pretty good. That's violent. NVIDIA's all over the place. Gold miners also. And let's see, crude just crossed over enough to be on the benchmark. It's looking pretty sad, really. That's a textbook bear flag. I'd watch for a bear flag failure, though. It's a really nice setup. The longer this flag extends, the longer that channel goes, the less of a flag it is and more of just a rectangle. And then, of course, if it fails a bear flag, it turns into a beautiful cup, and then we'll get maybe a handle on the end of that. Either way, we've got crude and we've got Bitcoin. Oh, yeah. Mara, Riot, SOS, Coin, MSTR, TSM. They're not here yet, but NVIDIA and AMD are also on that list. So is PayPal. I know it's strange to see those names on a crypto list, but that's just the way it is. Crypto is looking really good, though. That's one place I would be keeping my focus. But look how violent this is. It's a struggle right now. We want to let that play out a little bit. If you're looking at things in the pre-market for like pre-market stock, doing some trading in the, I'd be careful with this. Let it digest this news that moved it around. Because if it's going to stick, you can see how these are bottom fishing plays, right? This is coming back to life after being in the trash. So if it's going to stick, we get a nice breakout on something like Riot. You get to 14 easy. Got a half back measure here that we could get to. So if it's going to go, there's room. You don't have to chase in this pre-market trash. Looks like I got out of my short and coin just in time. That call credit spread that I put on paid out well in 2 days. Done and dusted. Okay, so we got crypto for crude. You know, it's saying that it's up, but that's not very awe-inspiring. It closed right at the low of the day. So that little bit of a move right there is why it's up. It doesn't tickle. So we'll let that one rest. And that just brings us back to the news part of all of this today. if that's all that we've got moving is some crypto Bitcoin proxy, then we don't have the rising tide. We don't have the fangs. We don't have anything else. That's what I would be watching for. Keep your eye on the sectors. See if you start to build that market breadth. Speaking of breadth, there's the bull scan and there's the bear scan. So, when I'm looking around asking what's moved in the pre-market and how many are bullish versus how many are bearish, we got more bullish names than bearish names. That can change in the next 5-minute tap of the server, by the way. So that's a really generic breadth. Once the market opens, we got, advanced decline and money flows, and we can certainly dial it in better than that. But the NY Fang doesn't move in the pre-market, so we're not going to get any reading off of that thing. The financials aren't enough to carry us by themselves, even if they wanted to. And we don't have anything else that is even close to hitting our conditions. All right, so with the dollar, we really want to be watching for a rejection here. It could time out really nice if we're going to get some sort of knee-jerk reaction and rug pull flip. We'd be looking for the Dixie to reject across yesterday's high. We would be looking for the 10-year to reject across either yesterday's high or this after hours Globex level up here. We'd want bonds to find support, not break down. Wow, Thinkorswim. And we'd look to try to get that V in, right? That'd be the focus. Remember, the economic data that comes out today will take precedent over any technical analysis. It's just the way it is. The half back level is 45.62. So if we're looking for a half back play and that V bottom flip or building a base along the lows, that would be my level to focus on. It also, by the way, lines up really nice with the open from yesterday. And those open, high, low, close pivots are just fantastic. So keep your eye on the clock, watch the news. Into the month, new month flows with performance chasing. Everything else is going on. The one thing we didn't look at is what they're doing with rates. Don't get complacent today where we think, oh, it's one of those Fridays we're going to just chop sideways, hold the highs, chop sideways, hold the lows, go into the close. I don't think it's going to be that way today. So maybe we'll give up on that 0-day SPX credit spread until we get a big move on one side, right? Then we can change our mind on it. All right, so nothing really has changed for December. Just a very minor consideration for a rate cut. Remember, it wasn't there the other day, right? There was no column except this column all week. And now we've got this tiny, tiny little print. For January, however, they priced in almost 3 points. We went from 4% yesterday to 6.9, round up to 7 for a cut, right? Talking about going from 5.25 to 5. Same thing, going from 5.25 for March, from 5.25 to 5. And then they're already pricing in, if they do cut in January, which would get us to 5, then in March, we'd be cutting from 5 to 4.5, 4.75, excuse me. So they are pricing in, they're pulling forward those cuts, right? And the Fed, at least Powell, has not said anything about cutting. He continues to say, we're not going to cut. But the market's reading into the fact that the Fed knows if they say we're done and they announce an official pause, that the market's going to go down. And they can already see the Fed's hand is kind of tied at this point, and they're bringing it forward. So that's worth keeping an eye on today. After we get the early data, economic data coming out, see if they really start piling in here and pull forward these rate cuts. It's been March. Remember earlier in the month when we were seeing only June and July, and then May started getting some action, and then March started getting some action. So if you want to save yourself from having to go through all of these, today I would really keep my eye on January. I don't think you could waste your time with December at this point. Just watch for January. See this thing get bid up today. If they really start counterbalancing that 93% chance that we don't do anything and start pricing in a cut, pulling it forward. That's what I got for you today. Be careful, be safe, watch the clock. Have a good weekend, everybody. I'll see y'all.